Hi friends, welcome back. If you are a new viewer on this channel, kindly click on the subscribe button so you can stay updated on every lesson that we post here. Today I want to show you how you can identify market structure as a beginner trader, how you can clearly define the structure of a trending market, whether a market is trending bullish or a market is trending bearish. There are key things you need to look out for to identify a market and define it bullish or bearish. Okay, so there are two types of market structure. We have a bullish market structure, that is when a market is trending bullish, and we love to see signatures of price forming higher highs and higher lows, or we love to see price showing willingness to continuously form higher highs and higher lows in a trending market that is bullish. Then in a bearish market, we love to see price continuously form lower lows and lower highs in a bearish market. These are the things that we look out for, but overall you need to understand that we use the candle wick to identify structures. Just the candle wick. A candlestick has a body, it has a wick. We understand that it also has an open and close. Okay, so but in dealing with market structure, we are only interested in using the candle wick for structures. Candle wick for structures and nothing else. Okay, so let's start drawing these structures. A bullish market structure, we said, is when price continuously form higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So you notice that there are two things in common. Number one, the higher lows are connected on a trend line, and the higher highs, the highs keep taking out the previous high. You see that? The next high takes out this high, then the next high is supposed to take out the previous high, the next high is supposed to take out the previous high. This is why it is called higher highs. This high is higher than the previous high, and this is called higher low because this low is higher than the previous low. This low is higher than the previous low in a bullish market structure. These are the things that you look out for. Again, you need to know that price is delivered in, let's say, two basic forms. When you see an expansion, there is a retracement coming near term. So this is an expansion. The retracement is that higher low formation. Price will trend bullish or will expand or will give you an impulse move to form the higher high, and then the retracement move to form the higher low. Impulse to form higher high, retracement to form higher low. Impulse to form higher high, retracement to form higher low. That's a bullish market structure. So in a bearish market structure, you love to see price showing willingness to form lower lows, lower lows, and lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. So two things in common. You would see that the lower highs are connected on a trend, and then the lows keep taking out the previous low. This low takes out the previous low. The next low is supposed to take out this previous low, this lower low. That's why the low is lower than the previous low. The next low is supposed to be lower than the previous low. Okay, you see that? This low is lower than this low. Then the next low is also supposed to be lower than the previous low. And again, price gives you an impulse move to form the lower low, a retracement or corrective move to form the lower high. Impulse to form lower low, retracement or corrective move to form the lower high. This is what forms a bearish market structure overall. So let's go to the chart as we see how to clearly identify these things on the charts. Okay, so we'll be going through a 4-hour chart of GBP USD. You can clearly see that the market was previously trending bullish here, and at a time the market began to trend bearish. So let's zoom out and see how we can start identifying the structures. Okay, just from somewhere. So let me just start from here. So you can see that this was at a time when the market was bullish. When you draw your trend line, it's going to connect the lows. You see that the lows are on this trend, except for the few times price will run on liquidity to continue the same trend or trending move. Okay, so price had a bit of consolidation here. This was a consolidation. Then price gave us an impulse move to form higher high here, higher high. Okay, the retracement move to form what? Higher low. Retracement to form higher low. So you can label this as higher high, then this as higher low. Okay guys, so again price gave us another impulse swing to form higher high. The high was higher than the previous high here, so you can see that this high is higher than this, so it's higher high, but the low is as well higher than the previous low, so that's why it's called higher low. Then another high that is higher than the previous high here, and another low that is higher than the previous low here. Then another high that is higher than the previous high, and another low here. You see that? So that's how price keeps forming higher highs and higher lows. Now this was a run on liquidity below this trend line. There's an equal low here, or relative equal low. If you have not watched the video on liquidity pools on this channel, please kindly go to that video and watch how to identify where the liquidity is residing, because institutions will always run towards the liquidity, where the liquidity is residing. Okay, so this was a run on liquidity residing below this relative equal low. They took out the liquidity and they continued the trend bullish, higher high, higher low here. So you can see that price keeps forming higher highs, higher lows, right? Higher highs. Again, liquidity is residing below an equal low here. You can see that institutions took out liquidity here. It doesn't mean that the trend has changed. We are still bullish. Okay, we are bullish. You may need to also understand top-down analysis to know where price is actually retracing into from here. So price continued with the bullish market structure formation, higher high, higher low. All this was a run on liquidity, remember, and then price form higher high. Then you see higher high, higher low here. Higher high, and then higher low. So this is just a typical example of how the market keeps forming structures, bullish market structures. We are bullish all this way up. Then let's go and identify a typical example of a bearish market structure, and I leave you to do your homework by yourself. Learn to identify these things by yourself, and you train your eyes to see these things. So you can see that the market had a bit of consolidation all around here. This was much of consolidation. Okay, so but then we see price gave us an impulse swing downwards to form lower low. So we can say that this was a low. You can label this as your low, and then price retraced to form lower high. So just the same way, the reason why this is called lower low is because each low formed is lower than the previous low, and each high formed is lower than the previous high. So that's why it's called lower high. Okay, lower low, each lower low is lower than the previous low, and then you can see that price formed another lower low here, then another lower high, because this high is lower than the previous low. It's lower than the previous high. Sorry, lower low. Then we had a run on liquidity here. Price had a run on liquidity above relative equal lows. Here there's liquidity residing above this. Price took out the liquidity, and then we continued with our structure formation. So right from here also you can see that the structures continuously formed. Lower low, lower high here, then this is a lower low, lower high. You can see that lower low, lower high. You pick out the most obvious highs. If you are struggling to identify the high or the low, just leave it. It's not the high or the low, it's not the valid one. So your high or lows has to be very obvious to your scene. Now if you take a look at this, you'll see that at the time price formed is very low. This is it, lower low, lower high. Then price formed a low that is lower than the previous low here. Still, don't forget, this is the 4-hour time frame. Price took out the previous low, retraced to form another lower high, then gave us another impulse swing to form lower low, retracement to form lower high, impulse to form lower low, retracement to form lower high. Now again, this is a run on liquidity above the buy stops residing here, relative equal highs. Price went directly and took out the liquidity residing above these equal highs, and price continued bearish. I'll do a video on breaking market structure, so you know exactly when the structure has changed from bullish to bearish or bearish to bullish, and then you follow structures. Okay, so guys, this is it. This is how to identify these structures. Go to your charts, practice these things until you can do it yourself, until you can see it yourself. Until next time, I wish you good luck, good trading.